When a lot of people think about investing, they think about the stock market or they think about real estate. But there are some amazing alternative investment options that can provide you with a great return without the headache of managing tenants or a property. I've done a few videos on my MIC investments, which are mortgage investment corporations. We have some other videos on it, so if you want to learn more, you can check out our profile. Essentially, I've invested in 2 funds that provide me with about $3,200 a month in passive income. I've gotten a ton of questions about how to research the funds, and I do like hours-long training on these. But to give you a quick overview and an idea of where to start, let's talk about the loan-to-value ratio and the mortgage position. When you invest in a fund, you want to find out what position the mortgages are that they're lending out. Are they first, second, or third mortgages? This is the order of how you will get paid out if for some reason the borrower ever defaults and there is no resolution and the fund needs to take back the property. First mortgages get paid out first, then second, then third, and so on. The less risky ones would be the first mortgages. And now loan-to-value ratio is also very important. This is how much of the value of the property is actually lent out. So for numbers' sake, let's say you have a property that's appraised at $100,000. The loan-to-value ratio is how much of that $100,000 you would actually loan out. So for example, you could look for a fund that has a 65% loan-to-value ratio, meaning on that $100,000 property, you would only loan out a maximum of $65,000. The loan-to-value ratio is very important because it helps you mitigate your risk. Because when you are investing in anything, you want to be thinking about the worst case possible scenario and how you avoid it. So with a low loan-to-value ratio, you're putting yourself in a position where even if the real estate market drops, you should be okay. What do I mean by that? Imagine you invested in a fund that loans up to 65% loan-to-value ratio. And let's say worst case scenario happens, the borrower defaults, they go through the whole process, the borrower is not able to make the payment, the fund has to take back the property. In the funds I'm invested in, this is very rare or has never happened. But let's talk worst case scenario. The fund takes back the property and the real estate market drops. The real estate market could drop up to 35% in this case, meaning value is going down by 35%, and you would still be able to sell the home and recover all of the money, meaning no money lost for the fund. There are so many different ways to do your research and to learn about mitigating your risk. Some people have talked about syndicated mortgages, and I would never touch those because usually you are financing the soft cost of a development, meaning like the sales office, the marketing. That is way too risky for me. Some people will do one-to-one loans. For me, that's way too risky. It's all about finding that middle ground of taking on as much risk as you need to get the returns that you want, but not so much that you're putting yourself in a bad position. The amount of risk that you're able to take on as well depends on your total financial situation, not just how you feel about that one investment. Again, I do hours-long training on these things, so this is just a starting point. You also need to understand the fund manager, the underwriting process, the clientele, the history, the dispute process. So please make sure you do all of your own research before you go and jump into anything like this, or get the help of somebody who has been there and done that before. I teach you about money. Follow for more.